Therefore, we have a vested interest as a society in both taking steps to counter this pressure and taking steps to limit the need for debt. The more college students are able to pay for their education with scholarships, and the more entrepreneurs are able to fund startup businesses with grants, the fewer of each relying instead on loans and credit, which means the fewer debtors with a vested interest in pushing for inflation. Now consider, early in his presidency, President Bush and the Republican-controlled Congress established a lot of tax cuts for the wealthiest 1% of the population. Those cuts are due to expire at the end of this year. If this expiration is not interrupted, the federal budget is going to start receiving a lot of revenue from this demographic. I recommend directing that revenue into small business grants, Pell Grants, and other forms of small business and educational spending. It seems to me that will be the best use for it. I've also learned something about exchange rates. As I understand it, there are two main factors that affect the rate at which one economy's currency measures up against another's. The first is relative inflation. If you have country A and country B, and the two use different currencies, and the inflation in country B is worse than the inflation in country A, that means that country B's currency is probably losing value faster than country A's, which weakens B's monetary unit faster than A's, or strengthens A's against B's, depending on your perspective. In other words, if today 2 of A's monetary units can be exchanged for 3 of B's, but a year from now 3 of A's can be exchanged for 5 of B's, it could be that country B has undergone worse inflation than A has. It could also be due in part to international stock trading. You see, the shares for sale on the US market are not priced in British pounds, euros, or bahts. They are priced in US dollars. So before we can trade shares on the US market, you have to have dollars to do it with. So if you're an investor in another country who doesn't have any US dollars and you want to begin trading shares on the US market, the first thing you need to do is exchange some of the currency you have for US dollars. By the same token, if you happen to be an investor in the United States with an exclusively domestic portfolio, and all your currency is in US dollars, but you want to begin trading stocks on the Indian market, you will have to begin by getting some of your dollars converted to, exchanged for, rupees. Now what if suddenly investors all over the world come to the conclusion that they have reason to believe that the Indian economy is about to enter a period of very strong performance and rapid expansion? Well, of course, being investors, they want a piece of that, so they want to begin trading shares on the Indian market. Now suddenly we have investors all over the world converting whatever currency they have to trade with into rupees, which drives up the demand for rupees, which in the absence of other factors strengthens the rupee against other currencies. I can also tell you something about recessions. You see, recessions and recoveries are about changes in the gross domestic product, or GDP, which is different from gross national product, or GNP. You see, a given country's gross national product is the total value of all the goods and services sold by that country. That is, by companies with their headquarters within that country. On the other hand, that country's gross domestic product is the total value of all the goods and services purchased within that country. To illustrate the difference, consider the electronics manufacturer Sony. This is a Japanese firm, meaning that its corporate headquarters are in Japan, but it sells a lot of goods within the United States. Those goods, once sold in the United States, count as part of this country's GDP. But because the good in question was bought from a company with its headquarters in Japan, this sale counts as part of that country's GNP. So when a given country's GDP rises, it means that more money is being spent in that country, spent as in changing hands. Of course, when it falls, this means that less money is changing hands. GDP is tallied quarterly and annually. When at least 2 sequential quarters show a decline, then we have what is officially called a recession. And when GDP begins to rise again, then we have a recovery, or expansion. Hence the GDP is one key economic indicator. Consumer confidence is another. This is what we call the confidence of consumers that they will have money to spend down the road. This is important because the more confident consumers are about that, the less cautious they tend to be with the money they have. Of course, the more confident people are that they will have money coming in tomorrow, the more they tend to be willing to spend it today. The more people you have spending money, and the more confidently they spend it, the better GDP does. So it's no surprise that changes in consumer confidence are usually followed by changes in GDP. Now GDP comes from 4 main sources: consumer spending, government spending, investing, and net exports. So these are 4 areas in which increased spending raises the GDP. In his first term in office, Bush and friends found themselves dealing with a recession. In order to combat it, they persuaded the Federal Reserve Bank to lower interest rates in an effort to stimulate consumer spending. It worked, but the resulting housing bubble paved the way for a more severe recession. But that's not the subject here. This act of using changes in the money supply to change interest rates is to the end of stimulating economic growth is called monetary policy. The Obama administration, on the other hand, in its effort to grow the GDP through increased government spending, is practicing one form of what's called fiscal policy. It's another form of fiscal policy to try to increase consumer spending by granting consumers more tax cuts. But then there's the question of whom to grant them to. Who gets to be counted as a consumer? Consider that poverty is generally considered a bad experience, something each of us would just as soon avoid. Usually, people are regarded as being in a state of poverty, an impoverished state, if their purchasing power falls below a certain level. Why is that? It's because the harder it is to meet your cost of living, the more you have to work to stay above a certain standard, the more the prospect of poverty looms in your consciousness, and the more willing you are to buy things and spend money to the end of getting a safe distance away from it. That is, to a distance away from poverty that feels safe, as if it probably won't just up and evaporate. So if you give $1 to someone in a state of almost poverty and another to a billionaire, which one is likely to spend it sooner? The former, of course. The desire to appreciably achieve and maintain a comfortable distance from poverty is greater than the desire to negligibly increase one's ascent into luxury, and the billionaire is more likely to hold on to the dollar until he or she can find some way to spend it on a money-making venture. So what if you grant tax cuts to the people in this country officially in poverty? Well, odds are most of them want to get out of poverty, so most of them will take this increase in savings and spend it, directly benefiting GDP. What if, on the other hand, you grant tax cuts to the people right on the edge of poverty? Well, odds are most of them want to get away from that edge, so they will probably take this increased savings and spend it, directly benefiting GDP. What about people who aren't quite right on the edge, but are still too close for comfort? Odds are most of them want to get far enough away for comfort. So if we grant these people tax cuts, they are most likely going to spend the increased savings, though perhaps with less enthusiasm, directly benefiting GDP, though probably to a lesser degree. It's not the amount of money itself which increases your distance from poverty, it's the things you have as a result. The more well-off people are, the less they need tax cuts, and the less tax cuts to them benefit the GDP. Well, there's a little taste of what I've been learning. There's more, but I think this video is long enough. We'll see though. If this is received well, I may make other videos on this subject.